I am so excited about today's dividend investing video. I am going to share with all of you my number 3 top favorite dividend stock of all time. If you've been following my channel for a while, you know that my number 1 favorite dividend stock of all time is Johnson & Johnson. And you know that my number 2 favorite dividend stock of all time is PepsiCo. And so I've got one in the healthcare space, one in the consumer non-cyclical space, and number 3, I think it's really going to surprise everyone because I'm over 7,000 subscribers on my YouTube channel right now. I am so thankful, so blessed for that. I share videos here on YouTube about my journey in personal finance and dividend paying stocks and my journey towards living off of passive income, off of dividends. And I get a lot of questions here and a lot of feedback and a lot of questions about specific stocks, but it's very rare. It's very, very rare that folks ask about this specific stock. And so I am so curious as to why that is. So I can't wait to see the comments below on this particular video. And I want to see what all of you think about my number 3 favorite dividend stock of all time. And I am talking about McDonald's. Let's get started. Hey everyone, so I'm back. This is going to be a great video today, all about my position, my thoughts on McDonald's Corporation, my number 3 favorite dividend stock of all time. I love this company. It's a great company. There's a lot to say about this company. Before I even get into this specific company, though, I want to illustrate why this is my number 3 favorite stock of all time. If you think about my number 1 favorite stock, Johnson & Johnson, we're talking about healthcare. We look at my number 2 stock, consumer non-cyclical. This is PepsiCo. Number 3, it's got to be in a different industry. So this one is a restaurant. This is a restaurant-based stock. And so I love that. I love that my top 3, they all complement each other. They're all a little unique and a little bit different. And they work together as a team. And so I really love that. And look, if I could only own one dividend stock, quite frankly, I would be fine owning either my Johnson & Johnson, PepsiCo, or McDonald's. Any one of those, I would be fine owning any one of those if I could just own one, hypothetically. But let's say hypothetically, I could only own 3. These would be the 3, and I would feel really solid about that portfolio. And now my portfolio has 37 stocks in it, but I always need to remind myself, hey, Ian, focus on the top ones. Focus on those top core positions because those are the ones that are going to drive the magic over the years in terms of dividend income. And so I first started buying McDonald's back in 2011, and I had waited honestly way too long. I had been watching this stock pretty much since I first got started in investing over 20 years ago. This is one that had always been on my radar, and I think it's probably on a lot of people's radars, although not on this channel apparently, because I rarely get comments about it, which just surprises me. But when you think about someone growing up in the United States and just kind of growing up as a kid, everyone is kind of exposed to McDonald's and that fast food, that food that McDonald's offers. And so from an early age, I feel like their marketing is amazing, that branding, just that connection with the brand. And so just that affinity that I had for the brand since an early age kind of informed my desire to want to invest in this company, to want to own a piece of this company. But I just so happened to get around to it in 2011. So I kind of waited a long time, but better late than never. Anyways, I purchased it for $73.53 per share when I first purchased McDonald's. It's gone up quite a bit since then. Right now, as of May 25th of 2018, we're looking at $163 per share. Basically, I'm up 122% in terms of capital appreciation on my original purchase price. So not bad. And I don't invest for capital appreciation, but it's surely nice to achieve some capital appreciation when possible. And it's an indication that the company is moving in the right direction, that the management team is doing all the right things. And anyways, when I first purchased, the dividend is paid quarterly here. I think way back in the day, I remember this one, it used to be twice per year, but now it's quarterly. And it came out to a total of $2.44 per share when I first bought. starting yield of 3.3%. Not great, but not bad. It's kind of in line with what I typically expect with a starting yield. The dividend has increased over time quite a bit. It's up to $4.04 per share right now. If I take the $4.04, I divide by my purchase price of $73.53, my personal yield on cost for my initial purchase of McDonald's is 5.49%. Not great, but not bad at all. 5.49% yield on cost for a world-class brand. An iconic brand like McDonald's, I'll take that all day, and it's only going to go up from here because this company has a history of increasing the dividend each and every year, and I expect them to do that in the future, and so I'm excited about that. So real good stuff here. Just on my 7 years or so, thereabouts, that I have been involved with owning the McDonald's company in my personal portfolio. And worth noting, obviously, this is a core position of mine. It's a very important position. Certainly not as big as my position in Johnson & Johnson, but I want to work on this one over time. I want to add more to it. Unfortunately, here in 2018, I'm not a buyer of McDonald's just because it's richly valued right now. Whereas Pepsi, for example, I am buying it here in 2018 because it finally dipped. I finally get a buying opportunity on that one. This company just has not dipped in the last few years. It's actually done quite well. It's gone up quite a bit. And the current PE ratio actually is a 25.62. That's a rich PE. And the current dividend yield, it's only a 2.5%, the starting initial dividend yield. And so that, in my opinion, is not a very attractive value for McDonald's. I think these numbers are high because the company is really starting to turn the corner and grow quickly again. And they're doing this because of some refranchising. I'm going to talk about this in a minute. I'm excited about this refranchising. And quite frankly, now that I've seen this refranchising work at McDonald's, I have more faith in my position in Coca-Cola as well. It's another stock I own. By the way, I'm going to link in the description below to all my videos about Johnson & Johnson, Pepsi, and Coca-Cola, so you can check those out as well. Anyways, just planting the seed there, this refranchising is really working for them. Revenue, earnings are all starting to turn the corner. Well, revenue is a weird one, but revenue from franchised businesses, from franchised stores is growing. And so I think they're starting to turn the corner on that refranchising, and it's pushing the share price higher because people are looking towards the future. But that being said, when I buy back at $73 and it's $163 now, and the PE is 25 and the starting yield is a 2.5%, it's just not for me in 2018, but I'm holding strong, I'm reinvesting dividends, and I'm waiting for a dip, because when the dip comes, I will be adding to my position. I cannot wait to own a bigger piece of this iconic brand that I love so much. So what I did next is I went into their annual report for 2017. And in the annual report for 2017, one of the first things that I noticed is the McDonald's company is very, very proud to show how they performed versus the S&P 500 and versus the Dow Jones Industrial Index. In fact, over the 5-year period, a cumulative return that I imagine includes both capital appreciation and dividends has outpaced both the S&P 500 and the Dow Jones Industrial Average. This is important to note here because I get all these comments like, hey, with the dividend strategy, you're always going to underperform the market. Why not just invest in an index fund? Why would you invest in individual dividend stocks? You will not believe how many times I get that question. And it's a valid question because I think the press out there, the media, it is so focused on index funds these days that I think investors more or less default to thinking, hey, index funds, they're the greatest. And don't get me wrong, I think there's many good things about index funds, and I commend anyone who is involved in investing at all, and whatever one's strategy is, I think it's a great thing to be partaking in, investing in one's future. Obviously, index funds are not the core of my strategy, but I have a lot of respect for them. But anyways, I get these questions, and I just want to point this out because, hey, if one invested in McDonald's, this is an old world company, obviously very well established. Is it growing rapidly? Maybe it will start to do that now. It's starting to grow. It certainly has some things in its favor, but it's a steady, big, strong, world-class brand. One wouldn't think, hey, does that beat the S&P 500 or does it beat the Dow? Well, yes, it can, and yes, it did for the last 5 years. And so that's a cool thing and worth noting. Anyways, I wanted to get into the numbers here. A lot of numbers here on this one. I spent a lot of time preparing for this video because I'm really passionate about this company. It's one in my portfolio that I may have the most passion for. And I think it just goes back to those early days that even when I was a young child, my mom would take me to McDonald's once in a while as a treat. Obviously, we didn't eat this kind of food all the time, but when we went, it was always a pleasurable experience. I enjoyed it. They had like the kids' play area. I enjoyed the food, and it's an experience. And so all the way from those days to present, I look back and I just have fond memories of McDonald's. And I think that's part of the marketing machine, quite frankly, that is working in this company's favor, and I love it. It is such a brilliant brand. So if one looks at the revenue on their 10K, they break it down by company-owned stores and franchise stores. And my understanding is that McDonald's plans on having 95% of their stores franchised and only 5% company-owned. They're reducing the number of company-owned stores, and they're franchising more. They're franchising them out. And what's really interesting about this is it's very similar to the Coca-Cola company's strategy on their bottling. They're refranchising. Instead of bottling in-house, they're franchising it out. And this is weird to me, both with Coca-Cola and McDonald's, but it just so happens that the franchised stores perform better. Or in the case of Coca-Cola, the franchise bottlers perform better. So literally, when McDonald's franchises out a store to an independent business, a local operator, that local operator does a better job managing the business than McDonald's themselves. Very interesting to me, and in some respects hard to believe, but in others I can totally believe it, because a local operator, when this one store or this few stores that they own, it is their livelihood, it is their bread and butter, they know their local community better than anyone, they can totally do a great job managing that franchise. So I understand it in that respect, and I respect it. Anyways, company-owned revenues are way down. We're going from $18.6 billion in 2012 down to $12.7 billion in 2017. So going down. We're actually down 32%. Company-owned stores, that's an intentional drop in revenue because McDonald's is reducing their own company-owned stores and franchising them out. Looking at franchised revenue, it's up from $8.9 billion in 2012 up to $10.1 billion in 2017. So it's up 13%. Now, this is important. This is not the total revenue that's driven by these franchise stores. I think the total revenue is up in like the $70-80 billion range. This is McDonald's cut. When the franchise store drives revenue, McDonald's doesn't get all of it. They get their cut because they're franchising it out. And their cut is what's represented here. And it's increasing because franchise stores are growing rapidly. And so, very key point here. When you add these up, total revenue is actually shrinking for the company, but operating profit, it's actually increasing. I get a lot of comments on this channel. There's a lot of debate around revenue, and a lot of folks think that revenue is the most important metric. And in general, I agree. In general, I agree that revenue is a very important metric. Never the most important to me, but up there. One of the top few most important metrics. But there are corner cases. This is one of them, where a company will intentionally shrink revenue, and it's not the end of the world. In fact, the stock price is way up, the dividend is way up, the company is doing well, all while shrinking the revenue because they're going after higher profitability. They're going to drive higher operating profits on a lower revenue base because the franchise model works better for them. And it's these insights that are so counterintuitive to most investors out there, and myself included. It's so against the grain. But I love it. I love these kind of cases because it shows that there are many ways to achieve great results in the stock market. And one of them is a shrinking revenue example. So I love that. Operating income. Operating income is up 11%. When you look at 2012, it was $8.6 billion. Now it's $9.5 billion in 2017, and it'll be higher in 2018. So the operating profit is increasing, and I am big on operating profit. I think operating profit is really important, and it's a metric I place a lot of weight on. And so it's very nice to see this metric going in the right direction and going up 11% over this time period that I'm sharing in today's presentation. So love that. Earnings per share are way up, way up. It's up from 5.36 in 2012 up to 6.37 in 2017 and growing higher in 2018. Earnings per share are actually up 19%, which outpaces the operating profit growth. The reason earnings per share is up faster than operating profit is because this company is reducing the number of shares outstanding, and they're doing it quite aggressively. They're doing it actually through debt. We're going to get to this in a minute. With any business that I invest in, I like to look at the pros and cons. And with this company, there actually are some cons. And I don't want to lose sight of them. They need to be top of mind for me. I need to pay respect to them. I need to be observant of them. And one of the cons is the debt that we'll get to in a minute. But the reason earnings per share I don't take too seriously here is the reason they're up so much is share count is reduced through share repurchases, which are being financed through debt. And one day that debt is going to have to get paid down. Hopefully it'll just be done through cash flow so that they don't have to issue more shares to do so. But that being said, I kind of, in any of these cases where earnings per share is way up due to shares being reduced, I usually look at the worst case. And the worst case is they're going to have to reissue shares at some point, and then it all reverts back. And so I kind of look at it as a worst case just to set myself up for no surprises. And that's quite frankly why I look at operating profit, operating income so closely, because it's not skewed by share count. And so operating profit 11%, I think that's more representative than this 19% that I'm seeing with the earnings per share, that 19% growth. So next up, dividends. My favorite thing in the world, or one of my favorite things in the world, are dividends. Dividend checks that can be used to pay the bills. And with McDonald's, the dividends have increased 33% since 2012. It's gone from $2.87 a share to $3.83. And obviously, since I own it, which is longer, it's more of a 7-year time horizon, I'm up 66%. So it's nice to see the dividends going up so quickly. What else? So here's something, here's debt as well. So we're talking about pros and cons here. I think pros so far, love the refranchising, love the franchised revenue growth, love the operating income growth, like the earnings per share growth, love the dividends growth. Let's get to something kind of negative, debt. Debt is way up. Debt is at $29.5 billion as of the end of 2017. It started at 13.6 in 2012. Debt is up 117%. That is massive. That is just massive. That being said, the market cap of this company is 128 billion, and I looked at their current ratio. It was real high. So these guys have more than enough ability to pay this debt, to have financed this debt, to pay it off tomorrow if they need to. And so I feel good about it from that perspective. The current ratio is good. The debt is not unwieldy at this point. That being said, I don't see this company having any sign of retracting or taking back their approach. In fact, I see it's more of like a full steam ahead here. These guys are all about taking out the debt to buy back shares, and it seems like they talk about that quite a bit in their quarterly reports, their annual reports. It's something they're proud of, and so I think this level of debt will continue to increase. And I think they're fine because they have the means to pay it. They have the huge market cap. The current ratio is good. That being said, it's just not for me in the sense that I'm not a fan of taking out debt to buy back shares. I'm a fan of buying back shares, but I like to do it through cash flow, through earnings. If one has to go beyond earnings by taking out debt to buy back shares, I just don't see the point of it. I understand why people have done it because interest rates have been at historical lows, but we all know now that rates are going up. And so this begs the question, as rates are higher, it's going to be harder and harder to refinance this debt at reasonable interest rates and to pay it down. And so that is just something that concerns me. And like I said, there's a lot of pros, but if there's one con that comes up, That's one of them. And actually, the next line item is going to be my next con, which is a bigger con. So in their annual report, they talk about cash flow, and they talk about cash flow from operations. And what I noticed in cash provided by operations, it's actually down over time. And so it was 6.9 billion in 2012, and it went down to 5.5 billion in 2017. And so we're seeing earnings per share go up. We're seeing operating profit go up, but we're seeing cash flow from operations go down. And so this is another red flag for me. There certainly is no way around this. Cash flow from operations is down 20%. Now, this is based on a cursory analysis. If I wanted to, I'd probably want to dig in here to the income statement, to the cash flow statement in more detail. But I'd be curious if you have any thoughts around that. If you've been tracking McDonald's, you follow McDonald's, you own McDonald's, what do you think about the cash flow from operations? And do you have any insights there as to what's happening? My takeaway is because look, the market, in my opinion, is in general, it's an inefficient market. Opportunities come up from time to time, and they come up because the market is not fully efficient. That being said, in big blue chip companies like McDonald's, it's somewhat efficient. It's somewhat right. It's directionally right. And because this stock has gone up so much, because it's doing so well, the market is not just going to completely ignore a massive red flag. And so it generally points me in the direction that, yeah, it's down, but it's probably not the end of the world and will probably work its way out over time. That being said, it's just a general rule of thumb for an investing standpoint. It's important to see operating income up and to the right, earnings per share up and to the right, and cash flow from operations up and to the right. And so when I'm seeing a little bit of a mismatch here, I'm seeing EPS up, I'm seeing operating income up, but I'm not seeing cash flow from operations up, I'm seeing it down. That's certainly something that I will want to continue to keep a pulse on. But when I just look at it at face value, I got a lot of pros, but I got two cons here. And the two cons that I have are the debt and the cash flow. Are they cons that keep me from loving this stock, that keep me from making it my number 3 stock of all time? No, because we're just looking at a 5-year period here. And this is a company that truly, truly has the power to stand the test of time. And they're showing that they're turning it around. I mean, this company, worth noting, has had to reinvent itself quite some times, many times. And we all know, even from recent history, do millennials like it? Do they not? I think McDonald's has finally proved to the world that, yeah, millennials do like this company and they're going to go eat there. And McDonald's has also proven via some of their more premium items, we'll get to this in a minute, but customers are willing to go to McDonald's and buy more expensive foods there. It's not just about fast food, it's about higher quality foods as well, and foods that cost more money. And so even the all-day breakfast menu, for example, this company is innovative, and they have had slumps over the years in same-store sales. They've had challenges from time to time with revenue, with customers, and they have always bounced back. And so the fact of the matter is what I'm trying to illustrate, this company has some staying power, has some serious staying power. So in the shorter run, if debt is up because they like buying back shares, so be it. If cash flow is flat, or it's not flat, it's down, cash from operations is down, so be it. Although if there is one real red flag out of any of this, it's that cash from operations. And so I'm kind of throwing it back there. I'd be curious if anyone else has thoughts on that. Not a deal breaker for me, but certainly the one big red flag that comes up here, and the kind of more minor red flag is the debt. Anyways, let's go down. I love this, stores. The number of stores are increasing. And I didn't break it out here, but in the annual report, it breaks down company-owned stores versus franchise stores. Company-owned stores is actually decreasing, while franchise stores is increasing. But because franchise stores are increasing so quickly, total stores are growing. And they're up 8% in this period, up to 37,241 stores versus 34,480 in 2012. Fabulous. I love the fact that this company can grow the number of stores like that, and they're seeing same-store sales growth grow. We'll get to that in a minute, but I love that. So this is the high level of it. Again, a lot to love, a few things to kind of earmark as things to watch over time, And I want to see over time where this debt goes. It'll probably increase, not the end of the world. I definitely, though, want to see where this cash from operations goes, and something I'll be watching over the next 5-10 years as I continue to hold and hopefully increase my position in McDonald's. But I want to get into now, what do I like about this company? Operating margin. So one can compute the operating margin by taking basically the operating income and dividing by revenue. Revenue, I have to sum up both the company store revenue and the revenue they get from their cut from franchise stores. When I calculate this operating margin, it's 42%. This, in a nutshell, is probably the favorite thing that I have from this entire presentation. If there's one thing you take home this. This iconic brand can deliver a 42% operating margin. It does not get much better than that. That is amazing. That is amazing for this kind of company in the restaurant industry. Maybe one would see this in the software industry, because to distribute software, there's no incremental cost to each additional copy. But there's some big costs to running this kind of business. They have to get the food, and the cost of food is increasing. They have to get the real estate. They have to build the stores. They have to manage all of these franchises. They have this huge corporate structure. The fact that they've got a 42% operating margin, it's just out of this world. It's an out of this world operating margin. I love it. It's one of the things I love most about this company. I cannot get enough of it. I love McDonald's. More of this stuff. So what else? The franchising, the refranchising is working. So that's something I love. We talked about this a lot. I don't want to belabor the point, but the refranchising is working, and it's evident in the numbers and the operating income increasing over time. So I love that. I absolutely love that. What else do I love about this company? The dividend growth. It's growing. We talked about this. Since I've owned it, it's up 66%. It does not get much better than that for a world-class blue chip stable company like this, and it will continue to grow. Something else, brand stability. This is a world-class stable brand. Look, I'm talking about my number 3 favorite stock of all time. At the top of the pyramid, where I'm thinking about my number 1, 2, or 3 favorite stock of all time, it has to be a stock that I'm willing to put everything in. If I had to, I would probably feel comfortable. I would feel comfortable putting 100% of my money in McDonald's. And the reason for that is I can sleep at night, because I know this is a brand that is not going to go anywhere. This brand is not going out of business. This brand is not going anywhere. They have a world-class brand. They have a competitive moat. There is no one coming in and taking and eating McDonald's lunch. It's just a tank, this company. And so I love that stability, and that is important to me. And quite frankly, maybe the dividend growth can be a little higher with another company. Maybe other companies, sometimes it's easier to get an initial value. McDonald's, it goes on sale from time to time, but it's not that frequent. And quite frankly, the reason for that is I think the investment community realizes the power and the strength of this company. And so I love that. What else? You've been following my channel for a while. You know that I love global diversification. And what is interesting about McDonald's is when one looks at the revenue that comes in from US alone, it's about 35%. 35% US, rest international. And so that is really cool. I love that it's even more skewed international than US. And it's a hedge. It's totally a hedge in some respects, because I have a US-centric portfolio. I try to buy companies that are globally diverse so that I have that global diversification. And I own companies in the portfolio that are globally based, but there's no way around it. I'm US-centric. And so knowing that my number 3 favorite dividend stock of all time has only 35% of its revenue coming from the US, that is just fabulous. What else do I love about this company? Real estate. I love this. I picked this up, I think, from a Forbes article or some article I was reading on the internet. Out of all their stores, these guys own 45% of the land and 70% of the buildings. This is not just a fast food company. This is not just a restaurant. This is a real estate company. And we've all heard that before. People talk about McDonald's. they've got some of the best real estate in the world, and that real estate has a lot of value. And what they're doing now that they're refranchising, what's great is they own this real estate and they're leasing it. They're leasing it to the franchisee. So those that are franchising out, the franchisees of McDonald's, now they are renting from McDonald's the land, the buildings in many cases, and McDonald's is earning a royalty, a landlord, a passive income, if you will, on that real estate each and every month. And so I love that. I love that about this business, that they've got that real estate locked up. And honestly, that may be why this stock has done so well also, is real estate has been an asset class that's done really well in the past, I'd say 5-10 years, or it's always been an asset that's done well, but I feel in the last 5-10 years, it's really come into the forefront, especially prime real estate, amazing real estate, incomparable real estate, and that's what McDonald's has. They have an operating principle. They don't take the second best location. They have to have the best location, and they've tied it up. They've tied up that real estate, and so I love that about this company, and I think it's a core differentiator, and I think it's just a world of value at this point that could never be replicated. That value just, it would be so hard for someone else to replicate at a reasonable cost. What do I dislike about this company? Share buyback. I love a share buyback, but they're just using debt to finance it, and so I have to take this earnings per share growth with a grain of salt. And then the cash flow obviously is a con. It's just something I want to dig into further and learn more about over time. It's not a deal breaker, but look, there's no stock or company in the world where everything is a green light all the time. There's always going to be some green lights and 1 or 2 red lights, and this has got 1 or 2 red lights, but I'm able to look past them. So before I end the video today, I want to also talk about their latest earnings report. They just reported earnings recently from the first quarter of 2018, and the trends continue. And so one thing that's really important in the restaurant industry or in retail in general is this concept of same-store sales. Are sales increasing, not just because they're deploying more stores, but because of sales actually increasing in the same store. In one store, comparable this year versus the next, are sales increasing? And McDonald's is experiencing some really great same-store sales. In the US, they're up 2.9%. When you look at Q1 of 18 versus Q1 of 17, they're up 5.5% when one compares Q1 of 18 versus 17 internationally, globally. And so they are seeing success with their same-store sales, and they are attributing a lot of this actually to some of the higher cost items on the menu. It seems like consumers are gravitating towards some of the more premium items, and so that experimentation they're doing is working out in their favor. One thing worth mentioning is the earnings per share, Q1 of 18 versus 17, it's way up. It's up 17% year over year. This is one of the reasons the stock is doing so well, and it has that high PE, because they're growing so quickly. When one factors out, though, currency fluctuations, they look at currency apples to apples year over year, earnings per share actually only up 12% year over year, but still 12% year over year is just fabulous. It's wonderful. That being said, some of that is driven by the share buybacks. If one looks just at operating income, which does not factor in those share buybacks, it's up 5.4% year over year. When one looks at Q1 of 18 versus 17, I'll take that any day of the week. 5.4% operating income growth year over year for a world-class company like McDonald's. In my opinion, that is just fine. It's great, and I love it. So what else? One last point here worth noting is the market cap. It's $128 billion. So in my opinion, it's a good size. It's stable. It's not going anywhere, but it's not so big where this company cannot continue to grow. I think they have room to grow. I think they will continue to grow, and I'm excited about that. So I'd be curious, what do you think about McDonald's? Please include that in the description below. I love the comments. I try to respond to all of them, and the support here on this community is just fabulous. It means the world to me. And if you enjoyed the video today, I please invite you to like the video, to comment, to subscribe. All of that means the world to me. And I'd be curious, like if you have a top 1, 2, or 3 stocks that you love, put them in the description below or in the comments below. You now know what mine are. Mine are Johnson & Johnson, Pepsi, and McDonald's. I'd be curious, what are yours? And so before we leave today, I do want to add a full disclosure. I own the stocks in my portfolio that I discussed today. The stocks that I discussed today are McDonald's, ticker symbol MCD, Johnson & Johnson, ticker symbol J&J, PepsiCo, ticker symbol PEP, and Coca-Cola, ticker symbol KO. Another one doing some refranchising. And in terms of a disclaimer, this is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Thank you. Thank you so much for watching. And if you made it this far, nice work hanging in there. And I wish you all the success in the world in your dividend growth investing. I will see you in the next video.